The Ensemble podcast is intended for professional financial advisors. All discussion is limited to publicly available information and should not be interpreted as legal, professional, or financial advice. Ensemble does not hold an AFS license nor provide any financial services. Before making investment decisions, you should obtain financial advice from a qualified financial advisor.
Hi everyone, it's Neil Rogan here from Russell, and today I'm joined by two of my colleagues, Alex Cousley and Samantha Foster from our LA office. And today we're here to talk about how Russell has designed, constructed and managed a private markets managed account for retail investors. So Alex, we might start with you just by asking how Russell approached this, and because this is really the first of its kind, how has Russell approached this and how are we managing the managers that are sitting within this managed account?
So to begin with, it is the first of its kind for retail offered through platforms. I think Sam can probably speak to this a lot more better than I can, but in terms of the way we deal with managers and the research side, we look at nearly 9,000 private market products globally. I think we have 120 or under that are considered buy rank. So there is a very healthy screen that occurs within those products. For the Australian solution, there's obviously the constraint that those products had to be available in the Australian landscape. And so that does filter down even further. And what we would ultimately trying to do and have done is build a portfolio that mimics a 70-30 exposure, so 70% growth assets, but in the private markets landscape. And so for a client that can then blend their listed 70-30 fund with an allocation to the private exposure and through the benefits of lower volatility and diversification benefits the privates offer, you can move up in terms of expected returns and you can move lower in terms of expected volatility.
So Sam, you've had a lot of experience with privates, having previously worked at the USC endowment. How many private markets managers would Russell monitor, and then how many do we invest in?
So we monitor thousands and we invest in many.
Mm-hmm. And for this managed account, Sam, what's our international lineup look like when it comes to the managers? So we've got KKR, Nuveen Churchill, Partners Group, Ares as a credit provider. So do you want to highlight maybe one of those and their capabilities for us?
Yeah, so KKR is a U.S.-based firm, but they have offices around the world. They are traditionally a buyout and private equity firm. They've been around for decades. They're well-respected and a really blue-chip firm. The fund that we're investing in here is their Evergreen Fund, which is a very interesting type of product and solution in the marketplace, particularly in the Australian market, because there's an Australian feeder with monthly liquidity for the private markets model that we've put in place.
Thank you, Sam. So, Alex, to the private markets model, what are some of the things we've looked at in terms of liquidity, getting money in, getting money out, and then as Sam mentioned, it's a 70-30 fund. Do you want to talk through how we've blended both private equity and private credit together?
Yeah, absolutely. So in terms of liquidity, so all of the underlying funds within the managed portfolio have monthly liquidity at the latest. So the private equity names are all monthly liquid. The private credit names are all monthly liquid. And then we have some daily liquid exposure. Of course, monthly liquid doesn't mean if you redeem from the portfolio, you get your money back within the month because of the lags of reporting unit prices and then fulfilling redemptions. We think that about 6 months in normal conditions is about the time it would take to get 100% of your money back from the managed portfolio. In terms of the blends, so we have got as a starting point 60% in private equity, 10% in listed infrastructure. And a good question is why listed infrastructure and not unlisted? The main reason is that monthly liquidity is a pretty big filter for infrastructure funds. Infrastructure funds tend to have quarterly liquidity. They haven't moved to that evergreen structure in the same way that Sam mentioned, where there's monthly liquidity. So we're using our global listed infrastructure fund, which we think is, has three of the best infrastructure managers globally. And then we have private credit through Nuveen Churchill, which is a US firm. Challenger, which is diversified across private and listed or liquid credit. And then Ares, which you mentioned earlier, Neil, they have a very, very highly rated global credit fund that is daily. So it's a blend across monthly and daily liquidity and then across asset classes to get us to this ideal portfolio.
There's been a lot of talk recently, Alex, about private credit managers in Australia. In the lineup of private credit managers we have in this fund, what are the managers we have in this fund? And I suppose the key question I have is what size are they in comparison to some of the Australian managers?
Yeah. Okay. So on the private credit, the pure private credit play is Nuveen Churchill, which is a US. They focus on US mid-market, and it's all private equity sponsored. So private equity companies go and buy a company. They use debt to finance some of that purchase. They will go to a company like Nuveen Churchill and say, here's the deal we're looking at. What do you guys think? And if it gets to their criteria, they'll lend the money to that company. The other two are Challenger, which is, as I mentioned, it's not purely private credit, it's diversified credit. And then Ares Global Credit, which is actually more liquid than private. It's actually all liquid credit. I think the point out Australian private credit, so ASIC has been very focused on this. One of the things we have observed is the Australian private credit market is earlier in its maturity than somewhere like the US. Like Sam has the benefit that US private credit funds have been running pretty large since the GFC. In Australia, it's more like the last 6-7 years. And I think
6-7.
Yes. To the point of scale. So the Australian private credit landscape is about $240 billion in Aussie dollars. And of that, about 50% is construction lending. So it's very heavily concentrated in one sector. In comparison, and Sam would probably know these numbers better than me, but I believe at least Ares has about $600 billion in private capital funds under management themselves. So they're 2.5 times the size of the Australian market.
And is that 600 US versus 200 Aussie?
Yes, correct.
Oh, wow. So it's nearly $1 billion US, $1 billion Australian dollars.
Yeah. Correct. Yeah.
Wow. And, in terms of platforms, this is clearly going to be available early next year. And so if anyone who's watching this today wants more information, what can they do?
They can reach out to someone at Russell and they can reach out to see what platforms are in terms of capabilities. One of the things
probably call me.
Correct. Yeah, you're probably the best person to call if you want to put your phone number attached to the podcast. The one thing that's also worth noting is because of the monthly application and redemption, a trading calendar is quite important. And so one of the things that we've built as part of this SMA offering is a calendar so that Sam and I, when we're thinking about portfolio changes, we can ensure that when we want to move from one manager to another, we do it at the right time so our clients don't receive cash drag excessively as money moves from one manager to the other.
Yeah. Well, I mean, we'll probably have you both back on once this is publicly available. But of course, this is something we've built for one of our wholesale clients, and early in the new year, this will clearly be available across 2 platforms for advisors to access for their clients. My final question is, in terms of the allocation in a portfolio, where would you see what size of an allocation and what kind of balance should a client have for this to be allocated to?
I'll take that one. I think it really depends on the client. The same way a retail client is different than an institutional client, they both have to think about the amount of liquidity that they need in their portfolio and the amount of short-term liquidity, the cash needs that they have over the next year, 2 years versus something that's like much longer term. But generally, from an institutional perspective, we like to think that you should take a sizable amount of risk to generate a sizable amount of return. And that means that you should try to maximize the amount of illiquidity so that you can generate a high return. And that really is a framework that institutional clients take because their goal is simply to maximize returns given all other variables.
Mm-hmm. Great. Well, thank you both. That's really all we've got time for today. And we'll stay tuned for some more information on this very exciting product early in the new year. Thank you.